All right, AAR Corp just dropped its Q1 results, and wow, the market is definitely paying attention. The big question now is, did the company just set the stage for a breakout year? We're going to break down the headline numbers, dig into what's really driving the business, and then give you our take on what to watch for next.
And look at this, right out of the gate. The headline number kinda says it all, doesn't it? A 10.2% beat on adjusted earnings per share versus what the analysts were expecting. I mean, AAR kicked off its fiscal year not just by meeting expectations, but by clearing them with plenty of room to spare. That sets a seriously bullish tone.
So let's talk about that headline beat. This wasn't just a narrow win. We're talking about a clean sweep. RSBR beat expectations on both the top and bottom lines. Let's break down the core figures that really powered this thing.
Okay, the number that really turned heads? $1.08. That's the adjusted earnings per share. This was the key profitability metric the street was watching, and you know what? AR delivered, big time.
And it's not just a good number in isolation. Check this out, a 27% jump compared to the same quarter last year. That's not just growth, that is some serious acceleration. It shows the company's earnings power is really kicking into a higher gear.
Now, that awesome earnings growth had to come from somewhere, right? Well, it was fueled by an equally impressive top line. Sales for the quarter clocked in just under $740 million, which signals really robust demand across their key markets. On the surface, that's a solid 12% year-over-year increase. But honestly, the real story is even better. Once you strip out a recent business they sold off, their organic growth was a blistering 17%. That tells you the core business is absolutely firing on all cylinders.
So the bottom line is this. AAR didn't just scrape by. It cleared expectations with significant headroom. This wasn't a narrow beat on just one metric. It was a decisive outperformance across the board, both revenue and earnings. And that is exactly what investors love to see.
So the big question is, where did this outperformance actually come from? To understand that, we need to pop the hood and look inside the numbers at the individual business segments.
The story here is all about part supply. I mean, look at that. This segment absolutely surged, growing an incredible 27%. It just blew past the performance in the rest of the business, which was solid, by the way. But part supply, that is the engine of AR's growth right now.
And, this isn't some one-quarter fluke. The CEO, John Holmes, he put it perfectly. The company has been executing this multi-year strategy to win and grow in new parts distribution. And what we're seeing now is just clear proof that this long-term plan isn't just working, it's accelerating. And crucially, this was profitable growth. It's one thing to grow sales, but it's another to make more money doing it. Their margins expanded, with adjusted EBITDA margin ticking up by 40 basis points. That's a great sign of strong cost discipline, and that positive shift toward the higher margin parts supply business.
Okay, but there is one thing we need to keep an eye on. Cash flow from operations was actually negative this quarter. Now, management explained this. They invested over $50 million in inventory to support that massive growth in parts. It's an investment for sure, but you can bet the market will be watching to see that turn into cold, hard cash.
All right, so with a strong quarter in the books, how did all this great performance translate into what management thinks is going to happen for the rest of the year? Let's get into the guidance. This is always such a pivotal moment on any earnings call, right? After a blowout quarter, the big question is always, okay, is this sustainable? Management's guidance, well, it tells us everything we need to know. And here's the crucial point. They're confident. They officially raised their full-year organic sales forecast to approaching 10%. And maybe more importantly, they tackled that cash flow question head-on, saying they expect to be cash positive for the full year. That's a strong signal that the Q1 inventory build was, just as they said, a temporary investment. The analyst Q&A session really hammered these points home. They're winning with this unique distribution model, making smart software acquisitions, and they're seeing positive signs in the used parts market. But maybe the most exciting thing for the long-term story? Management said their cross-selling opportunity is still in the early innings. That suggests a really long runway for growth ahead.
So, after digging through the quarter and the outlook, it is time for our take. Let's talk about our investment thesis and what we'll be looking for on the next earnings call.
So our take is really built on 3 simple points. First, the core driver, that parts supply segment, is just firing on all cylinders and it looks totally sustainable. Second, the key risk, the thing to watch, is that cash flow conversion. They have to deliver on that promise to turn the inventory into positive cash. And third, the verdict. When you combine this excellent execution with a pretty favorable valuation, well, it makes for a really compelling story.
So, based on the strong beat, the raised guidance, and the clear strategic execution, we are assigning an outperform rating to AAR Corp. We really think the stock is positioned to do better than its aerospace peers, as long as management keeps executing this well and that cash flow normalizes just like they projected.
And as always, just a reminder, this explainer is for informational purposes only. This is not financial advice.